everyone. My name is Sarah. Thank you for taking the time to join us tonight. Tonight's webinar is a preview into real estate investment and how it can play a key role in any portfolio by knowing key investment real estate fundamentals. Tonight we have Rich Arzaga, who is a serial entrepreneur. He founded Cornerstone Wealth Management, Insurance Whisperer, and Rich Arzaga on real estate. Rich will be covering concepts from his upcoming course, Real Estate Investments for Professional Advisors at UCSC Silicon Valley Extension. And with that, I'll go ahead and turn it over to Rich.
Sarah, thank you. I appreciate that introduction. I want to thank the UCSC for hosting this webinar. This is just kind of a little informal Q&A and introduction to the course that's coming back to UC Santa Cruz Extension. This course was taught back by myself in 2005 to 2008. And then I actually moved the course. I had some overlap. I moved the course to Berkeley in 2006 and have been teaching there ever since and coming back to UCSC here. So this is a little bit of a taste test or a teaser on that course, and maybe a little bit of discussion on real estate itself and answering some of your questions. Let me start this way. I'm just kind of curious. I know that we have somebody from Virginia here, New York City. On the chat, let's use this one for the chat. Can you give us an idea, give everyone an idea where you're at, what part of the Bay Area, or what part of the country? Idaho, Seattle, Bakersfield, Lincoln, Texas. Very good. Tucson, Senegal. So actually, there's more distribution than I thought. Lafayette. Okay, Nathan in East Bay. I think I know that, Nathan. Santa Clara, Maryland, right. Las Vegas. Well, that's a lot. That's a lot of places where they sell a lot of real estate. San Jose. Okay. Thank you for that. I appreciate that. South Wisconsin. There we go. Okay, so let's get started. A little bit about my background, because I think it's important. You're paying some money for this class if you attend the class, and so you want to find out who's actually teaching it. Like Sarah said, I had another career before being a certified financial planner. I was in technology for the most part. Last company I was with back from 97 to 2000, it did well. Even in 2000, we sold out to another blue chip company, and I was essentially retired, at least financially, at that time. And so when in 2001, 2002, I had a hankering for real estate investments. In fact, I already had a couple in my portfolio, and I had needed some help with investments on liquid assets, estate planning, taxes, all the stuff that you would want to hire a holistic or certified financial planner for. So I went out there to look for a planner to help me out in 2001 and 2. And the real struggle I had was finding a financial planner who knew a lot about real estate, who knew more than I did about investment real estate. The folks I met generally said one or two things. Half the time they would say, you know, Rich, good for you. Congratulations on this real estate and your interest in that. Why don't you go and just sell the real estate, and then we can put that money in bonds. Now, I didn't know that exactly at the time, but bonds are not the same as real estate. And second, they just really killed my appetite, my interest for that asset class. So for somebody that wants to know more about it, that really is a buzzkill to hear that your advisor just wants you to sell what you were interested in learning more about. So that was half, and the other half was actually a little bit more polite about it. They said, hey, congratulations, good for you on this real estate. Just give us your numbers, and we'll put them in your plan, and then we'll just go on from there. And really what I found was that wasn't really advice. It wasn't very collaborative. It was really very just, I give them data, they put it in the plan, but there's nothing more than that. And I couldn't ask a commercial real estate broker or a residential real estate broker too much, because they didn't know a lot about the tax or the financial planning implications on a directly held real estate. And besides that, they have an incentive to sell the real estate, just like a financial planner might have more of an incentive in some cases to offer stocks and bonds. That's how they get paid. It was a real gap out there, because in this country, 30% of this country's wealth is in real estate. that's either investment real estate or it's in homes that they own and live in, what I call lifestyle assets, the residents. So I thought this was a huge gap. So many people need help with planning. They have a high interest in real estate, and there's nobody that's going to be able to put this together for them. So that's when I started taking the journey of being a financial planner. Started that in 2004, really officially full time, and became the person that knew a lot about directly held real estate investments. Meanwhile, thanks to the licensing and the credentials, I've got a number of them. There's 3 of them that appear, I think, on the course outline, but I have about 8 or 9 of them. I just don't publish most of them. If I'm able to be the person I was looking for, finally, for people that I meet that have other financial matters and have real estate that they currently own, or they're inheriting, or they perhaps want to take a look at getting into, I can speak their language. So that's why I'm teaching this class. I started teaching this class early on, like I said, here at UC Santa Cruz Extension in 2005. And my students back then, they weren't 20, 21, 22-year-olds. They were people that were mid-career or changing careers, generally late 20s, mostly 30s to 50s or so. So, people that are established, but that want to know more about this. So I began teaching other financial planners about how real estate investments work. So coaching them and giving them the tools and techniques to help them with their clients and help their clients make better choices around that. So that's how I got into this business, and that's how I became a teacher. So fast forward, my last class I taught ended at Berkeley about 2 months ago, and there's another 25 students there. So hundreds of students have been through this program that you're looking at. So what I'll ask you to do is I'll ask you if you have an interest. For the ideal person for this workshop today is a person who's a professional advisor, who is a CPA, an attorney, trustee, financial planner, somebody who advises others and who advises others who own real estate, which basically is all of those folks. They all have clients that own directly held real estate, or real estate professionals, realtors, brokers. This is a good class for them as well. And then finally, real estate investors, especially investors that would like to get kind of the essentials or the basics on how real estate works. Because I think we all have an approach to it, but doesn't mean that we all know, how it works together and how to evaluate a good choice and perhaps decide to get rid of a bad choice. All right, so there's that. That's enough for the introductions here. The reason I think it's so important that either the advisor or the investor learn more about how this asset class works is that, in my experience, most people don't optimize their relationship or their investment in this asset class being directly held real estate. So what I see is I see a lot of folks that already have it that could have made some decisions early on or can still make some decisions now to help them improve the property, what it does for them, performance, that sort of thing. And so, but here's the bigger thing. It's not just getting better in terms of the investment, real estate investment that you hold. It really is about the impact of that asset to the overall plan. And it was really mind-blowing to see what happens when you take a mediocre or a poor performing asset and you fine-tune it, you exchange it, you even liquidate and pay taxes, whatever. There's several options that you can do to evaluate and then to decide to dispose of real estate investments. And so just doing something like that greatly improved a lot of clients' plans. It was the difference was significant. It's not something that you get another several $1,000s a year on. For many clients that held properties, the difference in their planning in their lifetime was over millions of dollars. So since 2004, now 2021, we've helped people with their decisions, and sometimes they most of the time they take our advice, sometimes they don't. Um, but either way, we've helped show them what the impact is of making tweaks in their portfolio in terms of the directly held real estate. So that's why it's important. That's what's at stake. What's at stake is I think, is the financial wellness of your clients or your own family or people that depend on you for good advice. I don't mean fatherly advice, like, this is a good thing to do, and rules of thumbs, because rules of thumbs are very tricky, and there's a lot of misinformation about real estate out there. I mean, people who know exactly how it works, and how you can help them, knowing exactly how it works. Now you can help them make these tweaks in their financial lives. So that's what's at stake, and that's why it's important. So let me go ahead and stop now, and take a few questions.
We have one question, a couple questions. Why was this course cut to 15 hours from 30 hours?
Oh, so it was the 30 in the beginning and it went to 15. Actually at Santa Cruz, it was always 30, and the 30-hour class was great. Some of you will love this. What would happen is you would learn about the basics the first half of the class, and meanwhile, you'd be in the 30-hour course. You would be tasked to go out and find a property that you would want to evaluate, something that maybe you're thinking about buying, and you would have to do all of the due diligence on that. Getting the financing, figuring out the entity, the stuff you learn from class, figuring out the cash flow, exactly how that works. Verifying the rents. It was a really cool class that way. And near the very end, it's a 10-week class back then. On the 9th week, you got to present your project, your investment, for 6 minutes to a panel of very successful real estate investors. I mean, these people that I had on the panel either own or manage hundreds of millions of dollars of real estate. So, and many times, because they were local here and the students were local, they knew the properties that you were talking about, the students were talking about. So it was very cool. It was like this. Now remember, back in that time, there's no Shark Tank. So we didn't invent Shark Tank. We just had a format where it allowed people to go up there and do their best, and then get feedback and get very constructive feedback from professionals as well as the instructor. So move it up to Berkeley at 15 hours. They cut all their electives, 30-hour electives, of 15 hours. So I've right-sized it to 15 hours. It is not the same. It is still very meaningful, but there's no time for the project. And as a result, it really is jam-packed with material. And then the deliverables, the final, and then the APOD, which is a cash flow, doing your own cash flow analysis. Those are the main activities that you have. So it's a very different class now, but it was simply because of time. All the electives back there at Berkeley Extension were cut from 30 to 15 hours. So I was just part of that. It was this was an elective back then. So long answer to a good question. Thank you for asking.
Another question we have is, will you be discussing the use of real estate in self-directed IRAs?
Briefly, probably more as it comes out as a question from students. So real estate in IRAs is a good idea for some people, but not for many, actually, because the one thing about real estate, you'll learn this in class, is that there's some terrific tax advantages. You get to write off the depreciation, what they call cost recovery, and it saves on taxable income. And then you also get to write off the mortgage interest if there's a loan on the property. And that goes away when it goes in an IRA account. You don't get those tax benefits. So there's that. And then there's other restrictions around having real estate in your IRA account. So we will talk about that probably for about 10 or 15 minutes. And I just gave you maybe about a minute of that, and we can discuss that. But when you go through the class and you see how it works, and we get to that question, then it really makes a lot more sense. It works for a few people, doesn't work for most, and most people don't have that capital in their IRA accounts to be able to make that lift to be able to buy that property.
Okay. Are most students advisors or investors?
Because of thanks, I would, this is odd, but thanks to uh, COVID, in terms of if there's an upside of this class has gone via Zoom. Because of that, as you can see from the question earlier about where you're from, instead of people from South Bay or Northern Bay Area, they're from all over the country. As a result of that, there's a mix. The mix of attendees are roughly about a third people that are earning their CFP designation and want their class credits for that. A third of that, and those people, they have other options, so they obviously have a bent toward real estate. Another third are CFPs seeking CE credits, 15 hours worth of CE credits for CFP, which is really quite valuable. And so you'll get that. I think there's a deadline to register for that, comes up real soon. So you have to let the program manager know very quickly if you're going to sign up and you want the 15 hours, because it'll be available to you. And then the other third are investors. So that's what the breakdown is. And it's really a very interesting mix because you hear from other people and their questions from their perspective. Okay, I want to share a screen now. And it's going to be a course outline. It's a draft, but it's pretty final. It's one I've used for a while. Reading material. I want to talk about this for a few minutes. So there's a lot of stuff out there, a lot of material out there for how to invest in real estate. The struggle as an instructor, trying to teach the fundamentals, meaning try not to slant it one way or the other. Oh, it's great. Oh, it's terrible. Most people that say it's terrible don't sell very many books anyway. But without trying to skew this so that you're led down this path, it's very tough to find a book out there that is that does a good job just laying out the basics, that doesn't incite passion or excitement. Because the last thing I'd want to do as an instructor is try to sell you on something that may not be suitable for you. That's actually very hard to accomplish. That's a good real estate investment. So I did find a few books that I'm comfortable with. The first one, these are books that you can read on your own. You don't have to take the class. I think the class is going to be definitely a lot more pointed than these books, but these are other resources that I offer to students. The first one is my favorite resource because it does a very good job just plain language with a lot of metrics, because there should be a lot more metrics in the decision to purchase investment property. But what every real estate investor needs to know about cash flow and 36 key metrics, I think that's been around for 15 years or so. That's a wonderful book. You can get that online, or you can get that in a book, but that's my favorite. And then there's two other ones that are fairly new. You might recognize this format here. Publisher is Bigger Pockets. They do have a number of books that do, what do you call it? They're enthusiast books. They're the ones I mentioned that are, you got to go out and get this, and there's nothing else. You got to get the real estate. And frankly, there's a lot of other things. And real estate should be just really a part of a portfolio or part of a plan. But that said, out of all of their books, because they have a number of them, they're a big publisher in this business here for real estate. The rental property investment book is pretty decent. It's okay. There's some pages I've taken out of here and use in the class. And then this one about managing property rentals. This is not bad either. There's some lists in here that are very useful. I think one of the risks of being a real estate investor or being an advisor and advising clients on their investments is that there's a lot of risks that are under discussed, I guess, or underrepresented. And one of them is the management risk, the risk of mismanaging the property, which I see often just by how the contracts are written, how the entity is created, or frankly, no entity, how the rents are increasing, and sometimes owners, investors don't want to increase the rents because they don't want to scare off the investor. And a tip for you on that is that's the wrong way to look at this. This is a business, and in fact, it's actually very healthy to increase rents over time. I don't mean being predatory. This is not a class on socialism. This is a class in real estate investing and making the most out of your investment, because it's very hard to do really well in real estate. So we're not being predatory around increases, but we are being market aware, so that you are getting, your what the market deserves and not underpricing, which will kill performance on a property. So we'll talk about that stuff more in class too. So those are the three books that I really like in this class, and there's not a whole lot after that that makes sense. There is another series of coursework. One of the designations I have is CCIM, and if you look up CCIM.com, you'll see that it's a national designation. It stands for Certified Commercial Investment Member, which is basically, it's the highest designation for investment real estate for cash flow properties, in the industry. So I have that designation, but they also have a very good and expensive program of coursework that's going to take many weeks and lots of money. And I think it's worth it if you're really serious. Some of my people from my class, that they step into that as a kind of a next step to increase their knowledge. But some of what's taught in that class is taught in our class here. We kind of survey the 5 weeks or 4 weeks they require. It's 4 weeks plus an elective, actually. There's grading. We can talk about that more if you have questions, but I'll just leave this for you to read. You can take this class for grade. You can take it for no credit as well, and pass or no pass. So those are your options. You don't have to grind too hard about the. I suggest that you do. You think about doing really well in this class, but you don't have to worry about showing this to your spouse or your parents. Okay. Let's go here. This is what I want to spend some time on here. And I want to cover the first one or two, and then we'll take some more questions. When you get this syllabus, the fifth page is a grid on what we're going to cover. So you'll see on the first box here, night number 1 is Wednesday. So we're going to get to know your classmates a bit. I'm going to make a case for real estate. And that's going to consist of showing you what happens when properly selected, a real estate investment is added to a portfolio, what the impact looks like. I'm going to talk about definitions, terms, and concepts. There's a lot of concepts out there, and they can be confusing for you. What is a cap rate, right? What is NOI? What is cash on cash? I like the sound of cash on cash, but what exactly does that mean? Because it sounds exciting, anything with cash on cash, where cash is mentioned twice, right? We're going to talk about those things, and we're going to clarify those. We're going to clean those up so that you know what that, and right away, just that first section right there in the metrics, how to evaluate properties. What is a decent cap rate? What should I be looking for in terms of internal rate of returns? Why is that important? And then you can compare that to how your properties are doing. Those are really valuable. We're also going to talk about debt, which is what leverage is about. Leverage is really debt. It's about getting a mortgage. And is it a good idea or not? And what is a shorthand way to figure out if it makes sense or not? And then about taxation. And I covered that just for a minute or so, but we're going to talk about that at greater depth so you can know exactly what the impact of taxes are. And perhaps you can use those to your advantage. So that'll be the first night. And what normally happens is that first night runs long, and I don't mind running a little bit long. These classes, so what'll happen is that if it runs long, it's not convenient for you, or if you have to miss a class, then you can watch the recording, because we're going to have these recorded, and they'll be available for a limited time. But you can always go back and if you're in class or if you missed it, either way, that's going to be available to you. So then we have night number 2. And night number 2 is I think what most people consider, one of the most interesting nights, because that's when they learn how to evaluate the real estate investment. So most of the goals that attendees have in the very beginning is, how do I know if I got a good deal or not? How do I know how to measure performance? Because you have to know, maybe instinctively even, that it's more than just about taking in gross rents and then paying out the mortgage and taxes and insurance. There's a whole lot more to that calculation than that. But the fact is that most of the folks that become clients or I meet, um, that's really the only tool they have to measure it in their tax return. I mean, they look at it and they don't know how to read the Schedule E or the K-1s in their tax return. This whole night number 2, will help you understand how to do a cash flow analysis on any property you would like. It could be a condo or a townhouse. It could be a duplex, and it could be also an apartment complex or an office building. The cash flow analysis that we're doing that night will apply to any investment property. It will not apply. It will not be useful for homes that you live in. So because you're not charging yourself rent, it's a whole different thing then. Maybe if you have an accessible dwelling unit, an ADU, a grandmother unit out there in the back that you rent, it would be useful for that, this cash flow analysis, but not for things that you consume, which is your home, a second home, a vacation home, that sort of thing. Okay, so those are the first 2 nights. Let's go and take some more questions now. Let's take a break and we'll come back to this list. Sarah, what do you got?
Yeah, I think we have time for a couple. So most of my clients are not real estate investors, but do 1 or 2 rentals. Will this class still be of value?
I think so, because most advisors have clients with 1 or 2 rentals. So that's really most of what in fact what we do at my I'm a certified financial planner. I think I mentioned that before. At my firm Cornerstone Wealth Management, of the people that own investment property, most of them have 1 or 2 properties. Most of the people we meet, I met a woman a couple of nights ago through Zoom who's out of the Denver area. She has 1 and maybe a second property. So it will help for that. It's not if that's what the question is. This class will definitely apply for that. In fact, that's who most of the investment community is around real estate, is a family with a trust or family that owns 1 or 2 properties.
What is your thought on lease options as an investor?
So I guess I know that strategy very well. There's a guy, in fact, he passed away maybe about, 10 years ago, 15 years ago, 10 years ago now, named Robert Bruss. He did a wonderful paper on it. I bet you can still buy it for like $3 or $5 on lease options. So he is definitely the expert in that. He's done a number of those, and he's an attorney who's helped a lot of folks with that. We're not going to be doing lease options as, in fact, this is a good time to clarify what we will and won't be covering. We're not going to be doing things like lease options because that's what we will be doing. Maybe the best way to answer that is what we will be doing is what most people expect their real estate to do. Most people expect to own investment real estate and for it to generate, most people or their clients, and own real estate and then generate cash flow that's passive that they can enjoy. They can get something every single month after the expenses. There's a little bit left, and they can use that to spend and basically go into retirement and rely on that for retirement. That's what most people want in their real estate investments is cash flow. They want a passive investment. They want something that's alternative to stocks and bonds. So that's exactly what we teach. What most everyone wants. If I had to guess, I'd say 95% of the people. Here's what we won't teach. Here's the other 5% that where this class will not be useful. It won't be useful if you're flipping or you're doing these options where you're flipping property, where you're buying it, you're rehabilitating for a little bit, and then you sell it for hopefully a profit. That's a whole different ballgame. The bottom line on flipping is that it's like a job, and a really good flipper might make maybe on an average year $150,000, $250,000 a year, but it's essentially full time. So it's like they've created employment for themselves doing something they probably love. That really, even though you hear it a lot, flipping is a very small part of the population, and None of my clients flip. Just to give you an idea. The other one we won't be covering. So we won't be covering flipping / lease options, and we won't be covering land development, where you take a piece of raw land and you shape it into a building or a, apartment complex. We won't be doing that because that's a whole different class. The Urban Land Institute, ULI, is a designation and also a community that does work with land development. But like I said, very few. In fact, I think one of my clients, he's just retiring now. He and his wife uh, did a very modest amount of land development, where they would take a lot, they would build a house there. That's what he did for his career with a larger firm. Now he did it on his own. So other than him and his wife, uh, most people don't, and most people in my client base don't do land development, and most people don't do that because, frankly, they don't have the millions of dollars to be able to fund that. They don't have 10 or 15 million dollars to be able to fund a 50 or 60 million dollar property, and get loans on that. So that's what we won't be doing. We'll be only working on uh, property that is held for cash flow purposes. Part of that will be figuring out, hey, I've got a property. I don't know if it's cash flowing or not. How can I find out? Or I've got a property, it's not cash flowing. I already know that. What should I do? Those are all in the scope of what we're going to be talking about. That's a great question. I'm glad that was asked. Let's take another question and then we'll go back to the outline here.
Okay. Does the current class still go through the financial analysis for cash flow and IRR?
Yes, it does. Night number 3, we're going to talk about, and by the way, these might shift because I might bring in speakers. Like night number 3, it's a great chance to bring in maybe somebody who does property management. There's a firm I love here in the East Bay area, San Francisco Bay Area, and their stories and their experience for property management are fascinating. I think that they're the most interesting part of the class, honestly, just hearing the grit and everything that comes with property management. And it's important because if you want to get into that business, either by managing it yourself or hire one property manager, that's something good to know. We'll also talk about entities. People ask, where should I hold my property? Should I hold it myself, joint tenancy with my parents, right? Should I hold it in an LLC? That seems to be the go-to for most people. So we'll talk about that and the merits of all of them. Because folks are from all over the country here in this workshop, I got to tell you the answer to that is going to be different by state. So we're going to cover the basics on that, and then still your local attorney, or again by state, will have the right answer for you. But at least you'll be primed to understand what they're talking about. And we'll probably talk about real estate investment trusts. Night number 4. This I think is really important. In addition to night number 2, where it's about cash flow, night number 4 is about integrating the gap between making a good investment decision and then what actually happens because of the emotion that people have around this asset class. So people have far less emotion around stocks and bonds, especially around specific companies. They might root for Apple or somebody else, but with real estate is very personal. And so a lot of as an advisor, a lot of our work and for you advisors that are going to be part of the class is around understanding what drives behavior. So we will be talking a lot about that. Some people really love this part of the class. We'll be talking a little bit more about capital gains, how to offset those, ways to mitigate highly appreciated real estate investments. And there's more than one way to do it. The one way to do it that people seem to default to is 1031 exchanges, excuse me, which by the way are up for grabs when they go to change the tax law. That's one of the things on the table, perhaps on the cutting board. I would bet $1 that it hangs in there, but you never know. So we'll be talking about other options in addition to 1031 exchanges. And then this is also when your APOD analysis is due. And so you'll have several weeks to work on it. You'll get support on that. I'll give you some tools. You'll be able to keep the tool. I think one of the most valuable parts here is that you'll be able to keep the APOD that you're learning on, which is very nice. I might switch that out in the next couple of years or so and bring somebody in who actually sells it, because there's prettier versions of these APODs. And when I say APOD, I'm sorry, I'm realizing I'm using shorthand here. APOD stands for Annual Property Operating Data. And that's kind of an awkward term, but it basically is a cash flow analysis. It's a tool that you use to evaluate the cash flow on your property. That's all that APOD means. So I think it's, again, a very important part of this class. And then finally, at the last class, there's a class exam. And I really mean it's a class exam, meaning that we go around the class and answer the questions and help each other out. I think my philosophy in this class, I teach other classes too, in this class, is that I like not just a test and to have people get it right or wrong, but also understand what's behind there. So I don't want to leave them getting something wrong and not understanding what the right answer is and why it was the right answer. So we'll actually open this in class, and I've never had anyone fail that final exam. I'll just tell you right now. Um, so, and then we'll talk about real estate and financial wellness, and how it brings financial independence, how it can, excuse me, it doesn't guarantee that, but it has the opportunity to help with financial independence. Case study on that, and then some resources at the very end. So that is the outline for this course.
Wonderful. Okay. Will this class go over real estate tax planning, short-term and long-term?
Aspects of it. So I'm not a CPA, I'm not a tax person, but we certainly do cover a lot on taxes. We cover the very important stuff. I think on a high level, we'll talk about tax advantages. We'll talk about how taxes work in the cash flow, what you can expect to see every year, every time when we actually break it down by, in any given year, here's what it looks like. We'll even break it down by assuming these data points on a property, the hypothetical property. When you sell a property, here's what taxes will be on this example. And then we'll talk about alternatives to paying taxes when you sell a property. So in that regard, there's a nice stacking of tax information. So that's what the question was about. Great. Me giving tax advice, I can't do that because I'm not a CPA, but we work on this stuff all the time. And what I said earlier would be part of the class.
Will we talk about 1031 exchange and how to liquidate rentals with the least tax consequence?
Now that's a leading question. So, I mean, the built into that question is the solution or the benefit, right? But the answer is we will talk about 1031 exchanges. Some exchanges work out, some don't. So I can tell you right now, just being totally neutral on everything, what everyone does, many exchanges fail. And the exchanges, so that I know people don't want to hear that, but that's the truth. So you need to be prepared for that. And the question after that is what happens next? Or what are the other options? So many exchanges fail. I like exchanges for some folks, some of my clients, and some of you folks out there, it might be totally fine. So there's that. And we'll talk about how to prepare for a 1031 exchange. There'll be part of that in the class too. But given 15 hours and all the stuff we have to talk about, it's going to be very concentrated. Okay, next question.
All right. Will you touch on how to charge clients when advising on their properties or their prospects?
I can tell you how we charge clients. So I'm happy to do that. How you charge clients depends on you, your service model, your level of, I guess, experience or education, your comfort level, that sort of thing. But I can tell you how we charge clients. It's, in fact, it's not on the rate. It's not on our website. We have our rate sheet on our Cornerstone WMI.com website. You'll see pricing there, but embedded in that pricing is real estate advice, so it doesn't break it down. I will break it down in class. That's not a problem.
Do you address investments in farmland?
No, I can, but only if the farmland is used for generating revenue. You can do you can do a cash flow analysis on that, the APOD. So that can be done. And, for example, one of my largest clients has conservatively over $95 million of farmland. And their income on that farmland consists of doing cattle themselves or leasing out space for others to do cattle. and also windmills. So that can make a nice cash flow analysis. In that case, by the way, when we did that, just to let you know, talk about what's at stake. Um, on that property, imagine it's $95 million. There's 85, 95. This is about 8 years ago, last time I looked at that number, 85, $95 million. There's no debt on that. So it's pure equity, right? The cash flow on that is everything is 2%. So now think about that. Think about I don't know how you feel about that, because it really is up to every individual investor how they feel about 2%. Some people think it's much better than zero, which it is, but that's essentially what they're getting at the bank today. And there's a lot more risk, by the way, having the land. But imagine if you came to me and I was your advisor and you said, "Hey, Rich, I have $85 million." And I'll say, "Great, I'll get you 2% every year." You probably would think that I sucked. So, so we can talk about that, but the answer might be really very good for you. I had one farmland recently that was at 6.5% out in, I think it was Iowa. And then the one example I gave you was at 2%. But I won't tell you how to go out there and go rustle cattle. I can't, or how to build a windmill, if that helps.
Okay. Um, will you be discussing what professional services a real estate investor should employ and reasonable cost guidelines for hiring professionals such as real estate attorney, tax advisor, etc.?
No, I don't think so. There's a lot in that question there. Like, for example, I talk about, there's an area where I do talk about the real estate team. And I talk about how important it is and who needs to be part of that team. So there's a discussion on that, and I do take questions on that. But in terms of who to select or how much they charge, it really is individual. That's case by case. My experience, though, is that if you get a very good real estate tax person or a real estate attorney, and they specialize in that, and you've got a complex problem, it's going to cost you a lot of money. So for me to kind of give you a ballpark on that, especially with the people all over the country, and everyone's like, I would imagine the Bay Area here is probably as expensive as New York, but not as expensive as some of the other places here, like in Texas. Um, I wouldn't be able to hit that spot.
As a follow-up to 1031s, will you
Mhm.
discuss DSTs?
Um, DST stands for Delaware Statutory Trusts. We will talk about those for a few minutes. Yes, again, remember 15 hours. We will cover that so that you'll know what that is and how it works. We won't we won't go into great detail in terms of the structure of one or how to create one, but we will talk about how that works so that you know enough to know if it's useful for you or not to explore.
Um, so I am slash want to be a real estate investor. Will you help me explore a property as a project for this class? Will you introduce me to a good commercial real estate agent, raise capital for down payment, and write contracts, etc.?
No, I can't, because that's way too much for the scope of this class. Um, you know, I can't do your laundry either, by the way. I, and I couldn't do a good job on that anyway. And I couldn't do a good job on some of those other things because that's really between you and those professionals. So, for our clients, we help them with some of that stuff, but this is not a pitch to generate more clients into a cornerstone. The class is not capable of helping somebody in that detail. But we will have a discussion on these things, and you will be better versed on what this means and how to approach this. And if you have questions, and as long as it's the class, providing that we have enough class time and that everyone's getting their questions answered, I'm really happy to give you some thoughts on where to find these resources. So I would say I'm more of a traffic cop in that area than the actual doer of that.
Do you address how to analyze real estate syndications?
Um, well, okay, so there's a couple of questions there. One is syndication. That term by itself, it really means that it's a group, it's another form of a group investment. So if I simplify that to, will I talk about group investments? We will talk about that a little bit. We won't talk about how to create one though. This is not in the scope of our work here in class, but we'll talk about what they look like. If somebody really wants to get more into syndications, there's some other resources. I can't think of the fellow's name now, but there's a guy in Southern California who's another CCIM. He does a very good job he wrote the book on syndications. So I can't remember his name now, but I'll probably offer some resources that way.
Excellent. So if anybody has other questions, we are running low on questions. So if there's something you'd like to add, feel free to add it to the Q&A area. Another question we have is, do we talk about BRRR investing, buy, rehab, rent, refinance, repeat?
What? No. I don't know. I understand what that probably means. No, we won't talk about that. So I guess the question to ask yourself is, does that involve buying, using tools and using a process to purchase a property to keep it long term and to live off its cash flow? And if the answer to your question is no, this is not like that, then we won't cover that in class.
Okay. I've taken a community college course on real estate intended for prospective real estate professionals.
Uh-huh.
Do you think there would be overlap on those topics?
I'm guessing that the real estate class in the community college for real estate professionals was probably about a class to get their license. One of a series of classes. I think there's 4 or 5 classes that are required before you sit for the real estate exam. Real estate exams are state by state. No, there's going to be very little overlap. What you'll find is that the classes that you take to get your licenses, by the way, I have a broker's license, a real estate broker's license. That said, I haven't transacted a third party deal, which a third party means somebody else's transaction. I've only done my own I haven't done one since 1993. Doesn't mean I don't know what I'm doing. It just means that I prefer not to do that. I prefer to refer that out or have you work with your agent. But what you learn in real estate class, or what you learn in, for example, getting your securities licenses, a Series 7 or 66, what you learn in there has very little to do with what you actually do in the business. It's more technical, compliance, ethics, that sort of thing. So I'm pretty sure there's going to be very little overlap.
From my understanding, we'll focus on cash flow analysis, cap rate, IRR, cash on cash, etc. Is that correct?
Yeah, somebody's listening well. Yes.
All right. And then will you talk about qualified opportunity zones for capital gain investment?
A little bit. That deserves a 2-hour course by itself. So 2 divided by 15 means that we're going to probably cover just a little bit, but that is definitely, the opportunity zones are definitely one of the ways you can mitigate taxes on highly appreciated real estate, businesses that you sell, stocks that you sell, stock options. That's a really good idea, but most people, not suitable for many people, but where it is suited, it's wonderful.
So the student joined late. Can you discuss the level you will cover on REITs?
Yes, probably about half hour to 40 minutes. That's the amount of time. And in that, we'll take a survey of what REIT is. What REITs are, real estate investment trusts, is what that means. And we'll talk about how they work. I find that people, if they get frustrated with trying to find their own property, they don't have the time or the capital, they don't have several hundreds of thousands of dollars, they don't have the confidence, that real estate investment trusts can be a decent alternative to what they want in having real estate in their portfolio. Not the same as directly held property, a lot less drama for REITs, frankly, because you don't have to go through all the other risks except for investment risk. But it's still an option for many people. Good question.
So bear with me, I'm not a technical expert
Okay.
on this. All right, will you teach due diligence on 1031 to DST or investing in non-public REIT?
No, not due diligence. Part of what what due diligence means is that there's an investment and somebody has to go into that investment and scrub it down totally. Just look at it and evaluate, the tenants, the property, the maintenance, the rules, the zoning, the management of it, the financing, all that stuff, and to see if it's something worth either representing or investing in. This class will offer some aspects of that, but this class won't be about due diligence on an investment. You'll get part of what you need from this class, but you'll actually need to do a lot more work than that. Your due diligence on any one property should be much more than 15 hours. And even when that happens, if you do a really good job, you'll find that you're going to walk by a lot of investments that look interesting, but you scrubbed it down, you did your due diligence, and they're not producing the result you want, and you wouldn't get it unless you were desperate to get something, which is not a fundamental of investing, being desperate. So no, we won't do that directly, but some aspects of due diligence will be covered in class.
Would you talk about the relationship between passive income and tax? For example, how the rental income affects LLC tax if the rental property is registered under a LLC, or how the rental income affects household income tax?
I think so. If I break that question down, because there's actually, I think it's unintentionally integrated or complicated. Well, we talk about the relationship between passive income and taxes. Yes, we'll actually show you how that works. And if you do your own APOD, which I hope you do, you'll actually see how that works in your situation. So you'll see for yourself. You're only as good as the data you put in there, but you'll see how it works. Rental income affects LLC tax. We actually touch on that a little bit, but it's forgettable. Briefly, LLCs are neat tools unless you have income over $250,000 gross income before even expenses are taken out. And I don't mean net income. So once you start getting over $250,000 in gross, which happens to big properties or businesses that generate a lot of revenue, gross revenue, then your tax, there's an excise tax on top of that. It's an extra tax on that. And that's really as simple as it is. I think the tax is maybe, I'm not going to guess, but it's small, but people are often surprised by it because they think the LLCs are so tax efficient. So I think that even answers that question there.
Will you spend, looks like a couple more minutes, will you spend some time discussing types of triple net properties?
We will take some time, and you'll mostly get some reading on different types of properties. So there's a whole section on that. I think there's 5 or 6 slides with pretty decent detail about classifications, meaning what type of properties are they under those 6 categories, and considerations, what you should think about. So we will cover that. Whether those are triple net or not are almost incidental. Triple net properties. It's just, so those are 2 different things. We'll talk about each of them, but not together like that. We won't necessarily review properties by triple net. Okay. Okay, folks, I guess I got another minute and a half or so. Thank you for being here. My experience is that students get a lot out of the class. And whether they use the tools or not, it's up to them, but most of them do. And I'm in touch with many students long after the class is over. So it's, I think in that way, it's a good experience. Podcast, you know what, I'm actually coming up with one for the National Association of Realtors. And actually the first series, the first 5 episodes are gonna be about alternatives to 1031 exchanges. Since that's on the plate, might as well talk about what else you can do. That's gonna be down the road. Okay, folks, thanks for being here. I look forward to seeing some of you in class, and good luck to all of you. All right, take care.